Hey, welcome back, guys. Today's video, we are going to be talking about a concept that can truly change your trading. And quite honestly, this has been the concept which has made me profitable in trading. We have spoken about this, but in today's video, we are going to go a little more deeper and we're going to go to the basics and how we can use this in your trading. Right? So, the concept is fair value gap. This fair value gap, if you truly understand how this works, it can be a game changer in your trading. So, so without further ado, let us straight get into the charts. Before that, what is a fair value gap? Fair value gap is a three candle pattern. When market is moving too fast, we will get to see fair value gaps being formed in the market. It is an imbalance that leaves behind an inefficiency in price. Over here, we have a fair value gap example. Fair value gap is a three candle pattern where the first candle has to be in most cases it will be a consolidation candle where it's either an up or down candle. It can be either an up or down candle, right? And whereas the second candle is the most important because this second candle is responsible for making the gap in the fair value gap. Okay, this second candle is always an expansion candle, and this candle always has to move further from the first candle's high. If in a bullish situation, it has to move from the first candle's high, expanding further. All right, and the third candle is what will determine whether price forms a fair value gap or not. Okay, so in most cases as well, the third candle is also a consolidation candle where it's a small candle where it does not overlap with the first candle's high, right? So there should be a gap. That's why it's called a fair value gap. We should be able to see a gap in the middle, and the most important requirement for this to be a fair value gap is that the third candle's low should not overlap, should not fill in the first candle's high. That is if it's a bullish situation. If in a bearish situation, the third candle's high should not overlap with the first candle's low. That is the requirement needed for price to form a fair value gap. Normally what price does is, why we trade using fair value gap is, when price forms a fair value gap, to rebalance, price will sting into the fair value gap to offer fair value. Okay, so let's dive a little more deeper into what a fair value gap is. Right, so for us to truly understand what a fair value gap is, we need to know these two terms. We have a BC and a CB. What is a BC and a CB? A BC is buy side imbalance, sell side inefficiency, whereas a CB is sell side imbalance, buy side inefficiency. Okay, it basically, a BC is a bullish fair value gap and a CB is a bearish fair value gap. For you to easily identify, you can see BC starts with a B, which means buy for bullish, whereas CB starts with an S, which is sell for bearish. Right, so that is what BC and CB is. Now let's go through one by one. BC, we can see that in this case, in this scenario, we have a BC. Why is it a BC? Because we have a buy side imbalance. You can see that price, only buyers were able to get involved in this, and there was a sell side inefficiency. Okay, just these three candles, you can see only buyers were able to get involved, and here there was an imbalance here. What is that imbalance? There's a buy side imbalance and sell side inefficiency. For price to rebalance, price can just sting into the fair value gap to continue higher to offer fair value. Okay, so why is price doing this? Because price always does one of two things. Price is either offering fair value or it is seeking liquidity. For example, for us to offer fair value, when price is going higher, it forms a retracement. Okay, in this high price, only buyers were able to get involved, and then we have a retracement where sellers were able to get involved. After this retracement, again buyers were able to get involved, and you see in this area we have not offered fair value, right? Because we have not offered fair value yet, because only buyers were able to get involved. Where is the fair value area? This is the fair value area. So for us to offer fair value, we need to retrace till this fair value area to then again continue higher. right? So this is price offering fair value. If let's say price is not offering fair value, if let's say now we have a new fair value area here, if price is not offering fair value, it is then seeking liquidity in the form of swing highs and swing lows. So when we see in the market, re- when price does not continue higher from the fair value area, that means price is seeking liquidity in the form of this low over here. So price would sweep the liquidity before continuing higher, and then we have another fair value area here. Okay, so this is how price moves. Price is either doing only one of two things, and this is known as institutional market structure, right? So this is institutional market structure, right? So this fair value gap offers a narrative to us in the market. They allow us to see where the market wants to go next. Okay, so you can see after this fair value gap was formed, price rebalanced, price thinked into this fair value gap, and it continue higher, creating another fair value gap here, right? So we have another fair value gap here, and price again formed another fair value gap, and it rebalanced from this BC. Why is it a BC? Because it's a bullish fair value gap. But there is a buy side imbalance, sell side inefficiency. So to offer fair value again, price retraced to this fair value gap, and it continue higher, right? So as you can see here, once price move to this area, we can already start to look for a buy here. Based on weekly, we can already head down to H4 to look for an entry. So here was the weekly fair value gap which we had. This was the weekly fair value gap, and we just need to wait for a sharp turn in H4 for us to take an entry. So where is our sharp turn? Where is our in and out? We have a in here. This is our in, and our out comes quite late. There's no any out here. This was our out. So for me, I would have entered a buy once price broke this high. I would have taken a buy, but there was no retracement, so there was no trade here, right? So this is just an upward movement for price. We don't have any trade here. Let's look at another example. Okay, let's go back to weekly. All right, we have another weekly fair value gap here, and price traded back into this weekly fair value gap. Okay, so let's see if we have an entry over here. So based on weekly, we can scale down to H4 to see if we have an entry, and you can see that price traded back in this area. Okay, there was a in. This price traded back into this fair value gap area, and there is an out. So when we have an in and out, we have a sharp turn. So this was the in and this was the out. I would I would have placed my entry here, taking a 1 to 2. Before taking an entry, we always have to see where is our draw on liquidity. This based on this is our weekly fair value gap, right? So this right here is our draw. This is our draw on liquidity. So when we scale back down to H4, the price broke this high, so we have an entry here. We can place a buy order over here. Stop loss covering the low. I usually like to place my stop loss covering the low, but you can also place it at the body, but I would prefer the low so that it gives more space for my SL, and covering a 1 to 2. And in this case, right, you can see here price did continue high, but for us to be safe, for us to have a good risk management, we can already set a BE once price takes this high. Okay, because once price takes this high, there is more probability for price to come back to our entry level, or you can even touch our SL once it takes the doll. So that's the reason why, for us to be safe, we should look for an entry before price hits the draw on liquidity. So in this case, if let's say we want to enter a more secure trade or more higher probability trade, we can enter based off of this H4 fair value gap using the concept which we just spoken, using the in and out concept, right? So that is how you can trade using fair value gap to get an entry. And fair value gap is a concept which you can use for everything. You can use it to get your direction, you can use it for your buyers, you can use it for your entry, you can use it for risk management. You can get all your answers if you truly understand how to use fair value gap. And there is no premise to how big or small a fair value gap can be. As long as it fulfills the requirement, it is known as a FVG. And these FVGs, what are these fair value gaps again? These are PD arrays in the market which we can trade off of. Okay, and as you know, price is always moving from a PD array and towards a PD array. So these are the time frame alignment which we use. As you would have seen that I went up and down the charts. When I was using a weekly PD array, I went down to H4 to look for a sharp turn, and when I was using a H4 PD array, I went down to M15 to look for a sharp turn, right? So there's a time frame alignment for this, so that we do not enter too early, and so that we do not take trades which are not high probability, because fair value gaps, it happens all the time, and not all fair value gaps work, right? It does not mean that when we see there is a bearish fair value gap, price is going to go down. Like as you can see here, we have a bearish fair value gap, but price did not continue lower, it continued higher, disrespecting the bearish fair value gap, and it continued higher. Why did that happen? Because of time frame alignment. This was not in alignment with the above time frame. So this is H4. Let's see what's this in the higher time frame. So if we scale up to D1, this is it. You can see in D1, what did we have here? We have a H1 fair value gap here. So for us to enter a sell, we have to wait for this D1 to get disrespected to then look for a sell. So that is how we can use FVG to make an entry. And we see here, we have a daily fair value gap here, but price still did not continue lower. Why did it not continue lower? Because based on this H1, based on this D1 fair value gap, we did not have any, right? So you can see here, based on this D1 fair value gap, did we have any H1 sharp turn? As you can see, we had no H1 sharp turn. So that is why price did not respect the D1 fair value gap. Sometimes based on a H4 fair value gap, we may get a sharp turn in M1 or M5, but we wouldn't have got any sharp turn in M15. In those cases, we want to wait for more confirmation. If let's say we are waiting in the lower time frame, it's better if we wait for more confirmation, wait for more FVGs to be formed, to then look for an entry. So that is how we can use fair value gap to trade. So in the coming videos, I will be making more advanced version on how we can use fair value gap to do a top-down analysis, and how we can trade using fair value gap to be a profitable trader. Right, so that is all for today's video. I will see you guys in the next one. Thank you.